Hi everyone, my name is Michelle and I'm a chartered accountant, co-founder and director of Money Savvy Move. And with Money Savvy Move, we're obviously a new accounting and advisory practice based in Auckland, although we do work with clients from across the whole country. And a little bit about myself is that obviously I work in accounting and strategy background across some of the largest organizations in New Zealand, such as Kāinga Ora, Department of Corrections, and I also actually started my career as an external auditor. So I do come with a lot of experience. So, obviously, in my role as a chartered accountant, I work with lots of small businesses as well as people considering starting a business. And often, one of the things that I hear a lot in conversation is this thing around, do I incorporate and become a company? Like, is this the right structure for my business? And you know what? I thought I need to record something and talk about it because I think there's a lot of misconceptions out there. But obviously, the first thing that I probably would just want to share is the current numbers. So, MBIE releases all these numbers all the time. And the current numbers are obviously up there where it sort of says 744,378. That's how many companies are in New Zealand at the moment, which is a lot. But at the same time, there's also a lot of like liquidations and stuff like that happening, which can be pretty sad for those people like in business. So anyway, the way I want to do this is that I want to share with you guys a bit of a story. So essentially, I am one of those people that have full on conversations with my Uber driver. And a couple of weeks ago, I was sitting in an Uber, chit chatting about it. And then this Uber driver told me that between him and his wife, they literally have four limited liability companies. Not one, not two, but four, which was wild to me. Like, there's nothing wrong with that. It's not right. It's just couldn't believe it. Like, one household with four, and obviously, him being an Uber driver, that was probably not one of the things that is going to be registered as a company. So it's pretty wild out there what people are doing. And as an accountant, I kind of panic because I'm like, did you fully think this through before you started up having the structure? So anyway, let's just take some moment to kind of like look at the New Zealand business landscape at the moment. Because you know what? I'm an accountant, and of course, I absolutely love numbers and spreadsheets. So I had to do a little bit of digging and then come up with some numbers. And pretty much as at 31 December 2025, there were 744,378 registered companies in New Zealand. That's a lot of structures sitting on the company's register if you think about it, because our population is not even that big. And then in the quarter of 2025 alone, there were 14,166 brand new ones. So that means new companies that have kind of been put into the register. Parallel to that, there's been quite a lot of liquidations as well. So there's sort of like 889, which is actually relatively high. And then I think another stat that's worth noting is that 97% of all sort of like New Zealand small businesses are literally small, as in less than 20 staff small. So those numbers are quite helpful, and they tell you something important, which is that incorporating a company must be pretty damn easy if there is 14,166 that can kind of happen in the space of 3 months. And so before we get into the big question around do you register as a company? Are you a sole trader, or what should you be? I'd like to just explain the key core structures that most people don't necessarily ever talk about when they think about business. So mainly there's like three key ones. The first one is sole trader, partnership, and company. Most of the conversation in New Zealand circles focuses entirely on the last one, to be honest, and the first one. Very few people talk about the middle one, unless they're like in fields such as like medicine or like law, or really like accounting where they sort of need to have some sort of like a partnership, but often people are always talking about like sole trader, company, and everybody forgets the other stuff in the middle. So obviously sole trader, pretty easy, pretty simple. And sole trader is often in people's conversation when they think about their taxes because they often use Henry to do their taxes, which is like a platform that you can use if you're a sole trader. So with a sole trader, it is pretty simple. Like you and the business are like one legal entity. Your taxes and etc. just one. Pretty simple. But like if things go wrong, like your personal assets could be at risk. And then the other one that obviously I said a lot of people don't talk about is the one around partnerships. So with a partnership, it's pretty much where you've kind of got two partners jointly liable, and they have like a partnership agreement or partnership document that kind of governs how things work. And then there is the company, which everybody loves to have. So with a company, obviously, is a separate legal entity. If you're limited liability, you've got kind of like protection up to a certain point. And obviously with tax for a company, it's usually sort of like 28% company tax. And then you also have directors and shareholders and all that kind of stuff. So obviously there's no, this is the better one or this is the worst one or whatever. They all literally just depend on your situation. However, the myth that I think we need to unmyth is that just set up a company so that you're going to pay a lot of less tax. Like there is this obsession that I hear all the time of people just trying to like reduce their tax or not pay as much tax. And it's like, look, your legal entity structure is not necessarily what dictates paying tax. Like if you're profit, of course you're going to pay tax. So anyway, a key thing that you should sort of like think about is that while the obsession of not paying as much tax is something out there, your company tax rate is essentially 28%. But then obviously if you're a sole trader and etc., your top personal tax rate is something like 39%. Of course, the company on the surface may look like it's a cheaper option. However, this is not correct. Because if you are a sole trader and you make taxable income of sort of like 150,000 and company makes a taxable profit of like taxable income of 150,000 as well, essentially the difference between the sole trader and the company is something like $117. $117. So it's not even that much. And then on top of that as well, if you're sort of like set up as a company, you have to do like company office returns every year. And then you just have to start to think about all these other things like who's a shareholder, director, shareholder salaries, and all of it. And all of a sudden, something that doesn't need to be complex automatically becomes complex. So when you're thinking about setting up a business, don't just assume you need to be a company. And so if structure isn't really the decider for micro businesses, right, then what is it? So like if you're coming up with a brand new business, what are some of the things that you should think about? And my own opinion of this is that you should kind of think of it in three ways. You should think of the first thing that you need to think about is your risk profile. Because obviously not every business carries the same risk. If you're like a consultant based from home and your personal liability exposure is relatively low, then you might, you're not going to be exactly the same as a trade business or somebody operating with a lot of like machinery where there's like lots of like, risks associated with what they're doing. So obviously there is that liability question, not really the tax question that you should ask yourself at the start. And then the second one is around, profit level and, like retention. Because I gave you that example of that 150,000 taxable income. So in theory, if you're making if your business is sort of like going to make less than 100,000 and there's no anticipation for you to grow significantly, then really the tax benefits, they're not that significant, to be honest. And then I guess the last one, which is quite important, especially now with like obsession of like startups and getting equity and etc., is that you need to think about growth. Like, what are your goals for this business? And you know what, with this one as well, it often just changes as the business evolves. So, like, if you're building something with intention of selling it at some point, or if you're planning to hire staff, if you think you might bring in like core founders or attract outside investment, then all of a sudden, like, that's probably where company sort of structure kind of starts to make sense. So it just like, I'm obviously not speaking as a lawyer because I am a chartered accountant, not a lawyer. So with a lot of the stuff, it's just think about the economic reality, not just your legal obligation when you're deciding what to do with your structure. And now let's talk about what happens when your business has already grown. So you have already been in business for a couple of years. Your business is kind of like mid-market, you're making a lot of money. That's also a good point to really think about your structure and see if it genuinely makes sense, because all of a sudden you are not like a micro business that's obsessed with the tax benefits. You're thinking more about like the strategy, like where you are placed in the market and what that means. The first thing that obviously changes is scale, is the need for a group structure. So one company is often not enough once you start running lots of different revenue streams, or if you have some other bits of your business that operates through like Australia or that kind of thing. That's where all of a sudden maybe you kind of need to do something a bit more complex to your structure. And also the second is where like the whole setting up locally versus having a subsidiary becomes part of a discussion as well. Because if you're sort of like set up as a company in New Zealand and then you have all these things that you do in Australia, if you don't set yourself up properly, there could be like tax obligations or like liability profiles and like government's requirements that you haven't really thought about. So then that's where, if in your creating your business or if you're at a growth phase in your business, having that structure that makes sense to where you are starts to suddenly become very important. And then the third one, and this one is sort of like underused, to be honest, because partnerships, structures for deals are often an option as well, because sometimes you don't necessarily have to have like a company and get people to buy equity or whatever. You don't need to do that sort of stuff. You can keep it very simple. And then obviously some of the other things that you kind of need to think about quite deeply when your business is growing is that if you're registered as a company, the Companies Act has quite specific director duties there, and also that also really does repeat what's happening with the business. So pretty much like that's where you can sort of see that the structure your business picks has lots of long-term implications other than just tax. And then I want to sort of like zoom out for a moment and give you like a bigger picture. So obviously everything I talk about, I have researched it. It's not just like things I'm just like dreaming up. And one of the key things that I sort of like looked into was a PwC guide that they released last year around doing business in New Zealand. Because obviously this is something that is so important to you deciding what kind of structure you want to have for your business. So some of the key things that they obviously talked about is that New Zealand has one of the most accessible company registration regimes in the whole world. It's pretty cheap to kind of set up a company here. And obviously company tax is 28%. And if you're GST registered, whether you're sole trader, company, whatever, it's 60,000 is kind of like your cap of when you need to register for TST. And then one of the most significant structural advantages of New Zealand is that we have no capital gains tax regime just yet. So obviously that makes business sales structuring particularly important, right? And it creates some sort of like competitive advantage for investors thinking about like exit strategies. The way you can structure today affects what you are going to sell. And obviously, there's just lots of other things that you can sort of like think about as well if you're operating a business, and that regardless of whether you're a partnership or your company, if you're going to be employing people, you also have to follow employment laws. And so if you're thinking about a business, it's not really just a conversation of, do I need to be a company or do I need to be a sole trader? There's just so many other things that you got to think about as well. And so now I have kind of like gone many places, talked about like different structures that you could have as a business. I have also talked about like if you're at the start of your business journey, if you're sort of like micro business and etc. And so let's now just bring it all together. And the golden rule hasn't changed, because essentially my key thing is that structure should follow purpose and not the other way around. You don't create a company and then figure it out. You kind of have to think about what you're doing first and then have a structure that kind of makes sense based on what you want to do. So this is obviously like a little framework you could use. Obviously, like I said, this is just general advice. Every person will be different. But if you are going to be a sole operator and your profit is under sort of like 80,000, then definitely probably stay as a sole trader, because really you might just be doing a side hustle. It's quite simple, low cost, there's no all these crazy tax things that you need to be thinking about. But let's say if you're making sort of 120,000 profit, then maybe that's where you start having to think about like, should I be a company or, partnership, whatever. And honestly, if you're now making like taxable income of sort of like 120,000 and above, and you're operating a business, not just like a solo type thing that is just you, then that's potentially where it starts to make sense for you to think about like really being a company, especially if you envision that you're going to grow and continue to grow. And then obviously, if you're running a multi-entity, multi-stakeholder business, you're definitely dealing in group structure territory. And then that's where you've got different company holdings, subsidiaries, and all that sort of stuff. And really that is potentially where you really need to have people in your team who know what they're doing, because you can't just wing it at that level. And honestly, I have also seen people that are not really making much, but have kind of set themselves up as like a group structure. And I don't know, it's just really, it can be, yes, there's things you can do that if you're not in a group you can't do, but sometimes I think people just boil the ocean. I think that's the term. They put things through a complexifier, and you don't necessarily have to do that all the time. You can keep it simple. Simple is good as well. So now let's just talk about some of the things that I generally see all the time that you don't need to be dealing with if you have listened to this video. Is that choosing structure for the wrong reasons is not a good idea. So just because you have a brand new business, you don't need to say you have a company so that people can take you seriously. You don't need to do that. Overstructuring too early, it just becomes a bit complicated, and you don't need complex when you're still figuring out what your business actually is and what it's doing. And then I guess the other one as well is your structure. If you're going to be a company, or if you're just operating a business, there is a business and then there is personal finances. Whether you're a company or sole trader, whatever, don't mix the two, because it just gets messy for like tax purposes, for like seeking finance and all that sort of stuff. So like regardless of your structure, just make sure that you sort of like separate those things. And then the other key thing as well is constantly review your structure every sort of like couple of years. Like what made sense at the start of your business might not necessarily make sense as your business evolves. And if you forget everything else I have said, because I have said quite a lot, think of these three things. The first one is structure is a tool and everything else follows. The first one is structure is a tool and everything else follows. And then the second one is that the math often doesn't work the way you think. So think of that $150,000 taxable income. You're really going through all that for like $117. And then if you're a solo operator, you're going to have to deal with shareholder salaries and yeah, it's just probably not worth it, to be honest. And then the third one is that obviously as your business grows, that's where the complexities make sense. And that's where if you intend to sort of like exit and stuff like that, that's where, probably might make sense to be. And so if anything, today has made you think about your own structure differently, whether you're just starting over or you've been operating for a while, you can definitely be in touch with me. I am obviously a chartered accountant. I am not a lawyer at all. Yeah, do know when you approach me, I'll be looking at it from an accountant's perspective and not necessarily from a lawyer's perspective. And as always, everything that I have produced is coming from somewhere. I didn't just dream it up. So thank you, and I hope to, if you like this kind of stuff, please just subscribe.